Hello. Before we begin, let's give everyone a moment to join and get ready. Today we will talk about where digital finance is heading and what really matter in 2026. The session is well structured, practical, and focused on real infrastructure. So once everyone is set, we will start. So I think we can start. Let's begin. Hello to everyone. Today I want to talk about where global finance actually is in 2026. Not in theory, not in white papers, but in real infrastructure that already exists and is being used. The title sounds complex, cryptography, card payments, digital assets, but the idea is actually very simple. All these things are merging into one system. For many years, crypto lived outside traditional finance. It was experimental, volatile, and mostly disconnected from real world payments. What we see now is very different. Digital assets are moving inside regulated financial infrastructure and becoming almost invisible for the end user. And that's the key idea of today's talk. Finance is no longer about new instruments, it's about new rails. And second slide about me. My name is Ivan Ordenko, and I'm the head of partnership and marketing at Trustee Plus. I'm really passionate about building strong partnership and creating innovative marketing strategies in the crypto space. My focus is on making digital assets simple, accessible, and engaging for everyone. I'm always exploring new opportunities to connect people, technology, and ideas. And today, I'm excited to share some insights about how digital finance is evolving, how institutions are shaping the market, and what it means for the future of crypto. First section about opening and macro context. Um, Crypto didn't become institutional overnight. From around 2016 to 2022, crypto was mostly an experiment. Retail users dominated the market. Regulation was unclear or fragmented. Volatility was extreme. For institutions, the risk was simply too high. Then something changed around 2023, 2025. Governments started working seriously on regulation. In Europe, MiCA created a clear framework. Custody providers became institutional grade. Stablecoins and tokenization moved from ideas to pilots, and now in 2026 we entered a new phase. Institutions can participate without breaking internal rules, and mostly important, digital assets are starting to behave like normal financial infrastructure. Um, what defines the institutional era? When we talk about the institutional era, we are not talking about hype or market narratives. Institutions behave very different from retail users. Then they don't chase trends; they build systems, and those systems follow a few very clear rules. First, it's regulated by design. In the past, compliance was added later. Today, it's built into the product from day one. For example, KUS, AML, today are part of the core architecture, not an extra layer. This gives institutions what they need most, clarity and predictability. Second, interoperability at scale. The institutional era is not about standalone crypto platforms. Banks, fintechs, blockchains, and card networks now operate as one connected system. Value moves seamlessly between them without the user needing to understand what happens in background. Interoperability is no longer optional. its requirement. Third, it's capital-intensive markets. Market flow are increasingly driven by ETFs, corporate treasuries, and sovereign adjacent capital. The capital is structured and long-term. It follows risk models, not emotions. As a result, infrastructure matter more than storytelling. And finally, trust first infrastructure. Institutions require security, custody, reporting, and strong risk management. Without this, it's simply not possible. So, key takeaway is simple. Institutional players don't chase narratives, they build systems. And in 2026, trusted infrastructure providers, especially regulated custody and compliance platforms, are at the center of digital finance. And the second section about market structure and assets evolution. For example, for a long time, crypto markets were explained in a very simple way. People talked about the 4-year cycles. They talked about Bitcoin halving. They talked about retail investors driving prices up and down. And for many years, this explanation actually worked. Most liquidity came from retail users. Markets reacted strongly to narratives. Volatility was extreme, and price movements were fast and emotional. But this model no longer fully explains what we see today. In 2026, the market structure is different. A large part of demand now comes from institutions, from ETFs, corporate treasuries, and professional allocators. These players don't trade every week or every month. They entire position strategically and hold them long term. This has a direct impact on market behavior. ETFs absorb volatility instead of amplifying it. Corporate treasuries reduce circulation supply by holding assets in custody. More and more crypto is locked in long-term structures and not available from short-term trading. This doesn't mean volatility disappears. It means volatility becomes more structured and more predictability. Crypto markets are slowly moving away from pure speculation and closer to how traditional capital markets function. Assets class roles. Another important change is that major crypto assets now have clear roles. In the past, many assets were traded the same way. People bought them hoping they would go up. Today, institutions look at assets very different. Bitcoin is increasingly traded as a store of value, not a payment system, not a tech platform, but a long-term assets held in custody, often via ETFs. Ethereum plays a different role. It's not just about DeFi anymore. Ethereum is becoming core infrastructure for Web3, smart contracts, tokenization, and settlement layers. Solana is positioning itself around throughput and performance. It focused on speed, low costs, and enterprise scale applications. XRP is evolving towards a regulated cross-border liquidity layer, especially in markets where compliance and integration with financial institutions matter. This shift is critical. The market is no longer driven by the question which assets will pump next. Instead of this, key question for today, it's what role does these assets play in the financial system? Crypto as portfolio infrastructure. All these changes are clearly visible in how portfolios are built today. Crypto is no longer treated as an exotic experiment. In the US alone, we expected more than 100 crypto ETFs. Projected inflows reach tens of billions of dollars. Which important is not just the amount of money, but how this money is allocated. More advisors are moving away from single assets bets. They prefer index products and crypto exposure. Surveys show that a significant share of advisors already allocate to crypto, and almost all of them plan to maintain or increase that exposure. Crypto is not replacing stocks or bonds, it's becoming part of standard allocation model. This is not temporary trend driven by high, is structural shift driven by regulation, custody, and infrastructure. And once crypto enters portfolio construction, it becomes much harder to remove. Now we talk about regulation as an adoption catalyst. The old mindset looked like this: regulation slows everything down, first innovation, then rules. In 2026, this logic is reversed. Regulation has become a condition for scale. Capital doesn't fear rules, capital fears uncertainty. Once clear requirements exist for the science, reporting, custody, and compliance, um, banks, funds, and corporations can enter the market without breaking their international mandates. This is why we see the launch of crypto ETFs, bank integrations of digital assets, and rise of regulated infrastructure providers. Regulation is no longer a barrier, it's a growth trigger. Um, so, um, the institutional custody requirements, no custody, no institutional adoptions. For institutions, custody is not a technical detail, it's a legal and risk management requirement. They need segregated assets, auditable reporting, AML and CUS enforcement, and operational and cyber risk controls. Then self-custody works well for individuals, but it does not scale for institutions. Key management, governance complexity, and legal responsibility make self-custody too risky at scale. This is why regulated custody is not a compromise; it's a structural necessity. Regulation is the gateway to scale. This leads to a key conclusion. Regulation does not just allow crypto to exist, it unlocks entire markets. Without regulation, you don't get, for example, ETFs and structured products, tokenization of real-world assets, institutional lending and yield strategies, or deep integration with traditional finance. All of this requires clear rules, defined responsibility, and trust at the infrastructure level. So regulation is not the final stage of crypto, it's the foundation for scale. Institutional markets cannot exist without rules, and crypto cannot scale globally without institutions. That is why in 2026, regulation is not the enemy of innovation, it's the strongest enabler. And now we talk about stable coins. Stable coins, it's mass market crypto. They're without exaggeration the most successful crypto product in history. And the reason is very simple: they solve real world problems, not just speculation. Price stability removes the main risk that kept traditionally users away from crypto. You don't have to worry about huge swing overnight. This makes stable coins usable for everyday finance, not just trading. They settle instantly across borders. You can move value globally without relying on slow banking rails. And importantly, they give dollar access to people who might not have a bank account, or for example, who live in countries without limited financial infrastructure. In 2026, the reality is clear. Stablecoins are being used more than many national payment networks. Daily volumes are comparable to the biggest card networks, and adoption is driven by not by ideology or hype, but by practical utility. So the key takeaway here is simple. Stablecoins are not a future use case. They are already core financial infrastructure. And stable coins with traditional payments. Now let's compare stable coins to traditional payment system. Traditional rails have real limitation. For example, high fee, slow settlement, and fragmented cross-border networks. Stable coins solve all these issues. Near zero marginal cost, instant or same-day settlement, and availability 24/7 globally. For an institutional or a business, this is game changer. It allows real-time treasury management, cross-border commerce, and liquidity optimization that just wasn't possible before. So when you hear stable coins, don't just think this crypto, think that this global payments that works everywhere, instantly and cheaply. Regulation turns stablecoins into trust infrastructure. Finally, here's why regulation is so critical for stablecoins. In the early days, stablecoins were almost like shadow finance. Users had to trust issuers without any efficient oversight. Now, frameworks like MiCA in Europe or other regulatory regimes make them fully compliant. This means reserve transparency, issue accountability, clear redemption rights, and mailing cost enforcement. With regulation, stable coins can be adopted by corporates, banks, and institutional investors. They can be held in custody, integrated into payment systems, and used at scale without legal or operational risk. In short, regulation turns stable coins from a niche crypto product into trusted, reliable rail of global finance. Stable coins are no longer optional or speculative. They are practical money, regulated, auditable, and already powering real-world payment. Now we talk about tokenization. Why traditional capital is inefficient. Traditional finance looks stable on the outside, but in reality, it's not very efficient. A lot of money is stuck in layers of middlemen. It's bank custodians, clearinghouse, and registries. Each layer adds extra cost, slows things down, and creates more risk. Assets are stored in separate systems that do not talk to each other. So everything takes longer and needs manually checks instead of happening automatically. Because of this, running these systems is expensive. Settlements can take days, compliance is slow, and money doesn't move as fast as it could. The result is surprising. Even thought there are trillion of dollars in the systems. A lot of this sits idle. Small investors have trouble getting access. Big institutions move money carefully, and overall, the speed of money slow down. This is not a failure of the market; it's a failure of system itself. What gets tokenized first? Tokenization does not start with the most exciting assets. It starts with the most logical ones. The first assets to be tokenization are those with clear cash flows, established legal frameworks, and existing institutional demand. This includes government bonds, treasuries, private credits, investment funds, real estate income streams, and commodities used in trade finance. These assets already move trillions of dollars globally, but they suffer from high settlement cost, complex custody, and limited accessibility. Tokenization directly addresses this pain point. The pattern is simple. Assets with the highest friction today gain the most immediate benefits from tokenization. Faster settlement, frictional ownership, and lower operational cost make these assets more attractive without changing their underlying risk profile. This is why institutional adoption leads, not retail speculation. By 2026, digital assets are no longer peripheral to the financial systems, they are part of its core. ETFs, corporate treasurers, and sovereign adjacent capital have normalized crypto markets by trading digital assets as infrastructure rather than experiment. This shift changed markets' behavior fundamentally. Institutional participation brings long-term capital, risk management discipline, and demand for compliance. Uh, Volatility decreases, liquidity improves, and adoption accelerates not because of hype, but because trust increases. The key traditional is this institutional don't chase narratives, they build system, and once those systems are in place, market flows. Yes, next is coverage digital stack. What we are seeing now is not isolated innovation, it's convergence. Stablecoins and CBDs provide programmably cross-border money, tokenized assets, enable capital efficiency, and near instant settlement. AI-driven finance automates payments, trading, and decision-making at machine speed. On top of this, NFTs and consumer-facing layers handle identity, ownership, loyalty, and engagement, and beneath everything sits regulated custody and compliance. Natural infrastructure that enables safe practice for all market players. Most of this infrastructure is becoming invisible to the end user, and that is the goal. When financial works best, users don't think about rails, protocols, or custody, they just transact. The next phase is not just about more people using digital assets, it's about them being everywhere. In the next few years, we will see trillions of dollars in tokenization real world assets and stable coins. AI-powered transaction will become a normal part of how money moves, not just a specific feature. A financial system will work across many currencies and payments networks, and they will be designed to work together from the start. People will start using this system faster, and I think it's very cool. The platforms that succeed will be ones that make digital assets invisible but essential, quietly running financial transaction everywhere. And 2030 is already here with Trustee Plus. This feature is not theoretical. Trustee Plus already provides seamless, secure, and regulated access to digital assets designed for real-world use, not experimentation. It combines wallet and infrastructure into a single experiment that makes digital finance practical, accessible, and trusted. 2030 is not something we are waiting for. It's something we all are already using. That brings us to the end of presentation. Thank you for your time and attention. I will happy to answer your questions and discuss any part of today's topic in more detail. How are AI-driven solutions reshaping risk assessment and fraud detection in fintech in 2026? I think in 2026, AI is no longer just a tool to filter data. It's now the main engine of financial security. AI systems have moved from being reactive to being fully agentic. They can handle entire fraud procession on their own. This means investigation alerts, checking transaction, and even prescreening loans without needing a human step in. Behavioral biometrics are now widely used. Systems can look at things like how someone types, how they swipe, or how hard they press on the screen. By 2026, these signals help detect cases where a real person is being coached by scammers in real time. Deepfakes are also is a big challenge. Um, Fraudsters use AI to create fake IDs and even a clean voice. In response, fintechs now use documents and biometric checks that can tell the difference between a real person and a very realistic fake. Finally, fraud and anti-money laundering teams have joined forces. Instead of working in separate cells, as they now operate on financial crime platforms. This is given them fully visibility across all channels, making it much harder for criminals to hide. What does it mean for digital finance to be regulated by design, and how is compliance being embedded into the infrastructure rather than bottled on? So, regulated by design means that compliance is built into the system from the start and not something checked manually after the fact. But compliance works like this. Instead of a compliance officer looking at spreadsheets, small contracts handle the rules automatically. If a payment doesn't meet KUS rules or other legal requirements, the system simply stops it from happening. Real-time auditability is also key with the EU AI Act fully in effect by August 2026. AI systems must be explainable. Automated audit trails show exactly why a loan was denied or why a transaction was flagged. This means the system is always ready for review 24/7. Mm, I have I have a quick question. Why the rise of real-time and cross-border payments? What are the biggest obstacles to global adoption? Even with fast domestic systems like FedNow in the US and PIX in Brazil, global adoption of instant payments still faces three main challenges. First is regulations differ across countries, which can slow down cross-border transfers and create compliance bottlenecks. Second, its liquidity issues means bank needs a pre-funded account in every currency, which is costly and hard for smaller player. Third, legacy systems still exist in many corridors where transactions are proceeded in batches, slowing down the flow of money. Mm. What's your opinion on how decentralized finance is evolving, and what role will it play alongside traditional banking in the next 3-5 years? I think DeFi has moved beyond its Wild West pace and is entering what we can call institutional era. We are seeing hybrid models or permission DeFi, where the blockchain technology is used, but users still need to be verified. In the next 3-5 years, DeFi will mostly act as backend settlement layer for traditional banks. This means you might still use your regulation. You still use your bank app, but the actual transfers of money between banks will happen on chain, making it faster and cheaper. One more question: which fintech innovation are most effective in expanding access to financial services for underserved population? I think by 2026, the most effective tools for financial inclusions are first alternative credit scoring using non-traditional data like utility bills, mobile airtime, or even social media activity to give loans to people without a formal credit history. Second is agent networks in areas with slow internet access. Local shopkeepers act as humans ATMs, helping people deposit and withdraw cash using simple apps. And third, stablecoin remittance, sending money home becomes much cheaper, dropping from around 6% globally to less than 1% using stablecoin rails. How are fintech companies balancing personalization with growing concern about data privacy and security? Fintechs are using new privacy technologies to keep your data safe while still going a personal experience. One example is zero knowledge proofs. This lets a user provide something like being over 18 or having a certain income without actually sharing personal details like a birthday or bank settlement. Another approach is adaptive security. Security checks only appear when something unusual happens. For example, a large transfer from a new city. This means that for most users, about 99% of the time, the experience is smooth and seamless. Using Trustee Plus as an example, our crypto wallets with stablecoin rails and integrated card payment making digital assets invisible infrastructure. Trustee Plus shows how crypto can become invisible in everyday life by linking a crypto wallet to a virtual card. Users don't have to worry about converting Bitcoin or other crypto into euro. Stablecoin rails handle the payments behind the scenes using coin like USDC, for example, in Trustee. From the merchant side, it looks like a normal card payment. From the user side, it's a simple a sweep. Simple swapping crypto. The blockchain and crypto complexity are hidden, making digital assets just another smooth part of daily life instead of a technical challenge. What role will digital identity and biometrics play in onboarding and authentical moving forward? Digital identity and biometrics are becoming central to how we log in and prove who are. Um, Biometrics are shifting towards passive recognition. You no longer need to blink for the camera or do extra steps. Systems can recognize you naturally as you use the app, making onboarding and authentication fast and seamlessly. Um, quantum computing is a looming challenge as quantum computers get stronger. Some current encryption method can be broken. Fintechs are already exploring quantum resistance cryptography to make sure data stays safe in the future. And Web3 and agentic commerce will also change things in the next few years. Your AI agent may have its own digital identity and wallet. It could pay for subscriptions, manage bills, or even negotiate better deals on your behalf, all automatically. Beyond AI and blockchain, which emerging technologies have the potential to disrupt fintech the most in the next few years. In my view, the biggest fintech disruptors in 2026 are likely to be first, quantum computing. It can optimize portfolio in seconds, but at the time, it could break current encryption. Banks are already racing to install quantum proof security. Second, in special computing, finance is moving from second as to third experience, and I imagine walking through your investment portfolio or seeing a bank teller appear as a hologram in your living room. Third is agentic commerce. This is a major shift. I believe that soon your AI agent will handle purchase, pay bills, and manage subscriptions for your automatically. Fourth is digital ID wallets. Government-backed digital IDs are replacing passwords and credit cards forms. In my options, one simple tap will soon prove you are, and you can pay at the same time. And five, it's 6G. Machine-to-machine payment will become possible. I can see a future where you fridge doesn't just order milk, it negotiates the best price and pays instantly, all without your involvement. So I think it's all. Yeah. Thank you everyone for your questions. It was a great discussion. I'm glad we had the chance to go a bit deeper into these topics. If anything comes up later, feel free to connect with me. Thank you for joining today and enjoy the rest of your day. Thank you. Bye.